Good day. Welcome to the presentation. Thanks so much for joining us today. I really appreciate your time. And what I'm going to be talking about today is managing risk in a fully invested South African equity fund. So for those that know Resco, you probably know our flagship Resco Value Trend Fund. It's a risk-focused. We use a lot of macro investing top-down, and we also stock pick bottom-up in the fund. And so the track record's there, the 17-year track record. And you can see the performance in the red line versus the yellow line. But what I want to talk about today is stock picking and managing risk with just stock picking. So what I have on this chart is I've got the dotted line, which is the performance with just asset allocation. And what you can see then is the total performance above it is the effect of stock picking. So over the last 17 years, the Value Trend Fund has had quite a big benefit from stock picking, and that's what I'm going to be focusing on throughout the presentation today. So for Resco, risk management is core to what we're doing. We're aiming for risk-adjusted returns for our clients. But what do those risk-adjusted returns, what should they look like? What do we think they should look like? So what we're trying to achieve with the funds is we're trying to have a lower standard deviation or low volatility, lower drawdowns, low correlation to the other funds and to equity benchmarks, and we're trying to get good returns for our clients. That's what we're trying to achieve. Now, of course, all those things are good. To get them all at the same time is difficult, so there's always trade-offs. When you're managing a risk a bit more, you have to sacrifice some return, and vice versa. But ultimately, what we're trying to achieve is a good mix of managing risk while getting good returns for our clients over time. So the focus for today's presentation is going to be on the Resco Equity Fund. And this is the track record since inception of the fund. It's a 7-year track record, and you can see that in the red line. It's got a good track record so far. It's beating the blue line, which is the capped Swix Aussie index, and the yellow line is the sector average performance. But what I really want to flesh out through the presentation, especially for those that know Resco and know Resco's risk management style, is how does that style play out within the equity fund? Now, the funds are all managed by the same team. Rob and myself are the co-PMs across the fund range. And we take a global and we take a macro view across the board. Of course, we're also looking individually at the different countries we invest in and individually at the stocks, but it's the same team and it's the same style across the funds. Now, how does this play out within the Resco Equity Fund? Being an SA equity-only fund, it doesn't have any offshore exposure, and it's a fully invested strategy. What you can see on the slide is you've got the standard deviation, the risk on the x-axis, and you've got return on the y-axis. And you can see that the fund, since inception, has had lowest in sector against the peers, which are all the other dots, lowest in sector risk for the category, and has had really good returns over the inception period, since inception period. And so this is what we're trying to achieve. This is what risk-adjusted returns look like for us. But of course, the sector is a little bit, it's interesting because there's a lot of funds within the sector that also have up to 20% global equities within the fund. And over the last 7 years, global equities have helped improve the returns and also manage risk through diversification. So if we look at the category but remove all the funds with global equity and just look at the big SA-only equity mandates within the CETA category, same slide but with just a smaller subset. The dot size is the size of the competitor funds, and you can see it's got all the major funds with the SA-only mandates there. And you can see that relative to that peer group, the fund has really good risk stats. And that's what I want to focus on this presentation, is how do we manage this risk? How do we keep this risk as low as we can within a fully invested strategy? Now, you can slice and dice the risk. I'm not going to go through every metric today, but another way of looking at it is beta. And textbooks will teach you that in order to get more return, you have to take more risk, you've got to take more beta to the equity markets. Now, we don't think that that's true. There's time to take beta, there's time to take risk, and there's also time to avoid risk. And so this fund, you can see relative to that same subset, this fund has had an average beta that's much lower relative to peers, but has still managed to achieve those returns with that low beta. Now, you'll remember at the beginning I said, what does risk-adjusted returns look like for us? And a key point for us is that the fund has low correlation over time. Now, why is this important? Is the Resco Equity Fund we see as a building block, we see it as a part of client portfolios. And for advisors looking to build a solution for their clients and to manage risk in that solution, having a group of funds with low correlation to each other really helps reduce the overall risk for for clients. And so this fund then can contribute to the risk management of client portfolios. So what this chart shows is over time, the ranked correlation for the CISA category, where the bar is high if it's got high correlation and it's low if you've got low correlation, and the shading just shows whether it's the top quartile or the bottom quartile. And the red line shows over time how much the Resco equity fund, where it ranks within correlation. And you can see that over time, the fund generally has had a very low correlation relative to peers. And we think this is really useful for the risk management of client portfolios. Now, why does it have a low correlation? Well, simply put, the fund invests differently. So you can see the top 10 shareholdings here relative to some large peer funds. And you can see that the top 10 is very different. And you can look at this over different periods. We generally have different equities. And so that then results in a very different kind of performance profile, whether it's volatility, beta, correlation, and so forth. Now, very importantly, we're not trying to be different. We're looking for shares that have good quality earnings. We're looking for liquid shares. We avoid small caps. We prefer larger mid caps, large caps, liquid shares, higher quality type of shares within the portfolio. But we benchmark agnostic, so we end up with a different mix of shares, and that's why you get those low correlations to peer funds over time. Okay, so how do we pick the shares that are in the fund? So the top 10 looks different, but what goes into picking those shares? So if I just unpack that a little bit, we're talking about active asset management, but we don't have active asset allocation. We can't move between different asset classes. We're fully invested, but we do see a lot of risk tools even while being fully invested. Now, earlier I said how the team, Rob and I, we manage all the funds with the same style and strategy, and we incorporate that macro research, those risks that we look at, those opportunities from a macro perspective, and we try and understand them. We're not always going to get them right, but we incorporate them into the way that we manage the Resco equity fund. And we think that's a really important risk tool in an SA-only strategy because the companies in South Africa operate within a global environment. Their earnings operate. You've got to understand currency, commodities, big trends globally in order to have a good view on future earnings of South African companies. And at the same time, global sentiment, risk on, risk off type of sentiment is going to impact what shares are performing well, where the risks are for a local portfolio. So that's really important, and we incorporate that throughout our investment process. Now, while we can't have active asset allocation between the different asset classes, what we can do is we can be very active in the way that we manage our industry exposure. So what the fund does is we move between different industries. So while at times we might have 0% exposure to a certain industry, then we might move to 20% exposure to a certain industry. So we're very active in the way that we manage our industry exposure. And that, of course, can help for returns if you get those calls right, but it also helps manage the risk where certain industries might be at higher risk of losing capital, and other industries might be looking forward to a period where risk is lower relative to the expected return. Now, I've put benchmark agnostic under the risk tools. Most people think of benchmark agnostic in the context of being a pure stock picker, a bottom-up stock picker. But I put it under the risk tools on purpose because something that we think is really important is not to let a market capitalization-weighted index determine the risk exposure for our South African clients. The reason being is the collection of shares that are on the JSE, the risk that you take when you match those types of weightings has no bearing on what we think is the correct amount of risk for clients to take. And so being benchmark agnostic, I'm talking about in the risk context where we're not taking risks based on the weighting within an index, we're taking risks that we think are good risks to take on a more absolute mindset. Now, we often talk about diversification in the context of gig sectors, say retail versus mining versus financials. But we think that there's a better quality way of looking at diversification, and that's across themes. What are the core drivers of why a company or a share might do well? And we try and diversify amongst these themes to get really good quality diversification, and that helps manage the total risk of the fund to bring the total risk down. Now, it's important, we are high conviction stock pickers, and it's always tempting as a stock picker to to load up with all your favorite shares. But we can get things wrong. We do get things wrong. And so making sure we've got the discipline and the risk tools to diversify amongst those different ideas, not to let the weighting rise up too high, is really important. And so we actively manage our total exposure to certain key drivers. In case they go against the fund, in case they go against our view, we need to make sure that we're protecting client capital. Now, in the South African context, we've had a lot of corporate landmines over the last number of years. And so research, looking at ESG, looking at governance, is a really important risk tool to avoid those drawdowns. It's a relatively small universe that we have to invest in. And so when these corporate landmines hit, they can hurt portfolio values. So having a research team that's actively looking at the types of risks around corporate landmines, whether it's governance, whether it's something going very wrong with the balance sheet or something like that, we find that's a really important risk tool in order to manage the drawdown risk within the equity fund. Global market cycles probably increased in speed, and having a research style and team where there's a very rapid response, debate culture, we've got the data at our fingertips, we've got the tools available. We find that's really important in order to react intelligently to the news events, to the macro risk that's happening at the time, and that can help manage the risk by being nimble, by being flexible in the allocation within the fund. And then on the return side, experience is important. Having the right tools available, being able to zoom out and have data visualization and see where shares valuations sit relative to local peers, relative to global peers, having a good research team, a deep research team, and also having an investment style which values learning and improving. So it's super forecasting style. We plot every decision we make against a share price chart. We're always trying to learn and improve. And then our style, we think adds value. It's quality, growth, at a reasonable price. We're looking to invest in growing companies but not pay too much for them. So a big debate in the industry is volatility of alpha or relative volatility versus total risk. What one do you want to take? Now, we focus mostly or almost entirely on total risk. We care a lot about the total risk of the portfolios. Relative risk or volatility of alpha or tracking error, we don't think is the right measure to target. And so you'll see that the fund, when you look at its relative performance, can be quite noisy. So what this chart shows is it shows the Resco equity fund, the quartile performance, so if the bar's high, it's in the top quartile, if it's low, it's in the bottom quartile, monthly since inception. And you can see that chart's pretty noisy. There's some really good months and then there's some really low months. Now, we're not actively trying to every month have top quartile performance. That's a noisy number, but the reality is it smooths out. The total risk is lower, and you get that compounding alpha over time. So we're not actively trying to target a relative risk. We're trying to target absolute risk. So our research team only has a buy or sell recommendation. We don't have hold, we don't have overweight, underweight. We have buy or sell. We look at a more absolute mindset when it comes to risk, not a relative mindset when it comes to risk, and we benchmark agnostic. So you end up with a smoother, more diversified risk profile over time. Now, it is a fully invested strategy, so I must emphasize it's not an absolute return strategy. It's just a mindset, it's our philosophy through the funds and in the whole team. And so we will have drawdowns, but you can see the drawdown in COVID, that correction was smaller relative, and we had a nice performance coming out of that. So we do try and manage our drawdown risk as best we can, but of course we aim to stay fully invested. Now, you often hear the term tracking error. Now, we don't think tracking error is an error. Fundamentally and mathematically, you know that to outperform, you have to be different. If you just match the index, then you're a passive fund. They're a good product. We blend nicely with passive funds. But if you want to be an active fund, you need to be different. And so we think tracking error is good. You want to have tracking error. But of course, that's not enough on its own. Being different, you've got to be different, and you've got to get more calls right than wrong. So you can have a high tracking error and get a lot of wrong calls. That's not what we're aiming to achieve. So of course you need to have it, but it's not on its own sufficient. And so we think it's important not to think of tracking error as this major risk. We are different. We're not trying to be contrarian. We just look from a fundamental, absolute stock picking perspective. We bring in the macro risks and we make the calls as we see that they make sense for good risk-adjusted returns, and we end up with what we end up. And it just so happens that moves differently to peers, to the index. Now, just coming a little bit back to the topic, active management and a fully invested strategy. Where can we be active? How active should we be? How do we incorporate active management when we have a fully invested strategy? And there's a lot we can do to manage risk, to be active within the strategy. And I'm just going to flesh this out a little bit and also just bring in some of our views, our current views on the South African landscape, the investment landscape and opportunities. Now, importantly, if you look at the all-share index excluding NASPERS, this is the capital return of the all-share index excluding NASPERS since the equity fund, the Resco equity fund's inception. Now, it's clear that this has gone sideways. This hasn't been a structural growth story in South Africa. Of course, NASPERS has generated some really good returns and there has been opportunities, but just as an index level, it's gone sideways. So we think it's important in South Africa to be very active. Because there isn't a structural growth story, there's not this 10, 15-year compounding return type story within this country. It's important, in order to find returns, you've got to work really hard. You've got to be active, you've got to be moving between industries, you've got to be picking shares, but when they become too overbought, the valuation becomes extended, you've got to turn them over into new opportunities. And so the fund has worked really hard to generate returns. And what's quite interesting is in this slide, you'll see the contribution of NASPERS within the Resco equity fund is that blue sliver on the top. But relative to the capped SWIX, it's contributed almost 40% of the total returns for the index. And so without NASPERS, the opportunities have been few. But if you move between the opportunities and you're active between industries and between shares, there's actually been quite a lot of opportunity in South Africa. Now, earlier I spoke about beta, and I showed that the fund has a lower average beta since inception. But the reality is beta is an output of our investment process. We don't actively target beta. And so what do I mean by that? So we build our portfolio, we look for good risk-adjusted returns. It just turns out that the portfolio that we come up with generally has a lower beta. But you can see in the recent period, the beta's actually gone quite high. Now, why is that? Well, it's our job to take risk, but we're looking to take good risks. And over the last few years, mining we have seen as being a good risk to take in South Africa. So they are high beta. We don't mind buying high beta shares when the upside, when the opportunity for those shares makes sense. So it's important to understand Resco and that we do like to take good risks when they make sense. We're not always risk averse. We're not always trying to hide from a market correction or so forth. When there's opportunities, we like to take advantage of those opportunities. Mining has been one of them, and we're willing, yes, the beta might rise, but the upside opportunity on a risk-adjusted basis, we saw as worth it, and we invested quite highly in mining shares over the last number of years, and that's benefited the fund. So having a look at the top holdings over time in the equity fund, you can see from 2018 to the recent May 2021, you'll see that the top 10 holdings have shuffled quite a lot. The highlighting is just to show the matches. They've shuffled quite a lot, and so we're very active in the way that we manage the fund, whether it's industry, whether it's individual shares. And so you'll notice on our fund fact sheet, you'll see the transaction costs are quite high. Now, of course, all the performance data we look at is net of transaction fees, but it's important to think about those transaction costs, and we take them seriously. But we see some trading over time as a risk management tool. We're willing to trade out of a share that looks overbought or a sector that looks like it's coming into some headwinds or some high risk. We think it makes sense to pay the 3 to 5 basis points, get out of that sector, get out of those shares, and move into places which are low risk. So we actively trade to manage risk over time, and of course also to take advantage of opportunities. Now you'll notice something, if you look at that May column, there's been some big changes in the fund recently. For the first time in a while, you'll see a lot of banks in the fund, you'll see a lot of SA Inc. We almost at 60% SA Inc. type shares within the equity fund. And why is that? Well, when the picture changes, when the opportunities change, we're willing to move the fund, we're willing to move the fund fairly quickly in order to take advantage of those opportunities. And a big change that we've seen has been this trade balance for South Africa. Now, yesterday's print's over 50 billion rand, and we think that that's more sustainable than what the market's pricing in. We see those commodity prices that are driving this high trade balance as higher for longer. Ultimately, they do fall, but higher for longer, and that changes the picture for South Africa. So our political risk has decreased. We're getting a really good trade balance, which reduces our balance sheet risk, and the global growth is looking really good, and that changes the picture for South Africa into a place where there could be some really good opportunities. And in the fund, we're flexible, we're willing to reallocate the allocation between the industries, as I spoke about earlier, quite aggressively and quite quickly in order to take advantage of these opportunities. So from this point going forward, we think banks could do really well. They haven't really been good performers over the last number of years because South Africa's growth has been quite sluggish. But going forward, we think that the benefits of this trade balance, the cash that comes into the South African system, the balance sheet of South Africa broadly gets better. And so this is a nice opportunity going forward where we think banks could do well. And so the fund has close on 20% exposure to South African banks and recently had close to zero. And we're willing to be active. We think this is a good way in order to manage risk within the fund. We've sold down on our mining shares and we've bought the SA Inc. shares. And that's going to help manage the risk because the mining shares, as you saw from the earlier slide, the equity prices have rallied hard. We still own quite a lot of mining. There's still opportunities, but we're looking to balance that risk out. We're looking to diversify. If you recall earlier, I was talking about how we're looking for good quality diversification. We want different ideas that can work with different drivers. So just the one point to note is that globally, we think US inflation, the risks are building, and we should be aware as South Africa. So just having a look at the slide, you can see the core PCE deflator, so US inflation, that's the professional forecasters' view for inflation for the year 2022. What you can see is that the forecasters have doubled the forecast for real GDP growth, but they've kept inflation forecast flat. Now, this kind of summarizes the view in the market at the moment in global equities, where global equity valuations are high, and the market sees high valuations, growing earnings, low interest rates, the Fed printing money and buying $120 billion of bonds a month, large fiscal stimulus, a lot of cash flushing into the system, a big revision up in GDP growth, and all of this can happen without there being an impact on inflation. Now, we think the pressure's building, and ultimately, inflation risk is a significant risk, and we should be aware of South Africa. Why? Because if the US inflation goes up, the whole story unravels. Cyclical commodity prices correct, they come down, that drops our trade balance. Emerging market or risk assets, whether you own emerging market cash, bonds, equities, they correct, and the whole story around South Africa unravels a bit. So we think this is a risk that's really important for South African equity investors, and we're looking to manage this risk as best we can within the Resco Equity Fund. So just to wrap up some of my key points, it's all about risk management. I ended on the big risk instead of a positive note for upside. We do think there's opportunity, but we think at the same time, there's this negative tail risk that we've got to be very careful of. And so risk management is important to the way that we manage the equity fund. And despite being a fully invested strategy, we can be very active in the way that we manage risk, the way that we can diversify amongst themes, we can move between industries, and ultimately, what the Resco portfolio management team and the research team brings is we think that having a global view on macro risk, global markets, it's critical to a South African strategy. Of course, you've also got to look at South African macro risks and take that into context, but you've got to incorporate the global macro risks at the same time. It's really important, and it served the fund well in managing some of those big global events over the last number of years. Stock selection should be integrated with risk management. You should be thinking about risk, and we try and do that quite carefully within the fund to think about the risk for our clients when it comes to stock selection. And so being benchmark agnostic, you're picking shares, but ultimately this idea of not letting the market cap benchmark dictates the risk exposure for the fund. You can think about it about corporate risk versus client risk. What are we looking after the most? So one might say it's too risky for me not to own this stock, or you might say, and this is our view, it is too risky for me to put clients' money in this stock. So one's managing the corporate risk, one's managing the client risk, and we focus very strongly on client risk. We think about the risk for including client money in the stock, not the risk of whether we will perform differently to peers or to the benchmark. We're willing to take that risk in order to protect the total risk of client funds. So just to conclude, we think the Resco Equity Fund is a really good building block. It's a really good product to be included in client portfolios. Because of its risk-managed approach, we're a small emerging market in South Africa. We're going to have the turbulence of our local story. We're going to be impacted by global events. And being risk-focused is important for South African strategy. But at the same time, there's good opportunities that emerge over time within South Africa. And so the fund's flexible and it's agile to take advantage of those growth opportunities as they emerge. Thank you for joining us. I really appreciate your time.
Can you believe it? That brings us to the conclusion of day one of the Virtual Investment Forum for 2021. Now, we trust that you've thoroughly enjoyed the market-leading content that we've shared with you today and look forward to welcome you back tomorrow for day two of our conference. We will be unpacking the theme around gaining momentum. Again, we have some phenomenal speakers lined up for you who will be sharing their insight as global leaders from institutions across the world. Tomorrow, we kick off with a great panel discussion hosted by Brandon Zietzman from Portfolio Metrics. Now, this is where he'll be interviewing 4 leading CEOs from the asset management industry and gaining their insight into the challenges facing the modern-day asset manager. That's all coming up tomorrow. We look forward to seeing you then.